All right, what is up, everybody? Welcome to another real estate wholesaling live analysis. If you're new here, welcome. My name is Elton, like Elton John. I'll be your host for today. If you've been coming to all of our series, or our past series, this is our 40th series for today. We're already getting close to like our 50 point mark, really close already as well too. Not only that, but we're also getting really close to our halfway of the year, just a couple more months, and we're going to be heading over towards June. So welcome to another real estate wholesaling analysis where we go over some real estate wholesaling overview on what the analysis looks like whenever you're looking at a property and try to determine like a few things as well too, if what makes like a deal work, where your offer should be at in terms of that deal. The way these meetings usually go, though, I am going to be walking through like a quick presentation, so that way you guys get understanding a little bit of basic information in terms of like real estate wholesaling. Afterwards, there's going to be their live analysis. If you happen to have like an address that you are working on currently, or it's about you're about to start working on, but you kind of want some help or need some assistance in terms of like getting it analyzed, by all means, drop the address in the chat so that way we can go over that one. And afterwards, which we can go over the analysis. After the analysis, which is going to take probably most of the time, there's going to be some Q&A if you have like some questions regarding like real estate wholesaling, something that it involves like the analysis. Anything outside of that, I recommend setting up a one-on-one session to answer like all your specific questions regarding where you're struggling the most in terms of like your real estate wholesaling analysis process. And afterwards, it's gonna be like a breakout room where you can where you can network with one another. Um, and from there, that's pretty much it. So with that being said, let's just jump into the presentation real quick. So first things first, when it comes to real estate wholesaling, it is a business and you have to treat it as such a business. From there are major steps that build the entire business, just like there's operations, there's sales, there's marketing, there's like all these departments in a corporation or a business. You pretty much have to manage it all, unless you're working with like a friend or have like a partner already working with you, then you guys are splitting up like the work, try to make everything, try to build your own process basically. And your own process is what's going to make you the money that you need to make, because the process has to be repeated every single day, just like any other business overall. The main part that you're going to be focusing on this on these series and what's constantly all about, it's basically going over the offers, so where the offer should be standing, where the repairs should be like averagely about in terms of like condition wise. Some of the properties that we look into, sometimes they're off market, so it's really a little bit more challenging because we don't have a lot of information on that property. And usually off market properties are going to be working directly with sellers, so it's getting that information from the seller directly. Some of the analysis that I've done and that I do on these live series is going to be on market property, so that we can get like a sense of what to look for, because there's going to be pictures provided by agents from there. So we'll get to analysis in just a few seconds. But the first foundation about first foundation about doing analysis is understanding like the markets, or knowing where your market is going to be at. If you don't know like your market, I'll show you a few steps that are literally less than 30 seconds to how you can analyze your market. If you niche down specifically to like a zip code, then that's going to be a whole different story, but it's also doable through the process I'm going to show you guys when we start doing some analysis. But the first foundation is ARV. And what ARV is, pretty simple. It says it on the words, after repair value. And basically, this is what your market is all about, telling us what the properties can go for once they get fully fixed up, because that's what it is after repair. Once it gets fixed, when it comes to the time of getting it flipped, this is how much the property will be. Occasionally, it also depends on how long the property is going to take to repair. So let's say right now we're in April. Um, so if we come across a project property that it needs some fixing and flipping, it'll probably take 2 or 3 months. So 2 or 3 months from now, we're looking around July. July is usually a very hot time where a lot of properties go. Additionally, too, right now, something that we're keeping an eye of additionally is rates. So if rates start coming down, prices of properties can definitely go up, especially in July. It can definitely go up even more significantly as well, too. So there's a lot of factors that can contribute into like the pricing as well too, because when it comes to getting it flipped, it can go over asking or it can go under asking, depending on a bunch of other factors beyond what the market is doing, which some of them are the rates on what's happening out there. Now, when it comes to investors and how they analyze properties, it's really, really important for you to know how your investors buy at the end of the day. Because if you're just looking for random properties out there, you're basically just hoping to get a deal. And then when you have that deal, you're just hoping to get a buyer. It's really gonna go, it majority of it will definitely go south on you, or you probably have to cancel like on the deal because you don't know how a lot of those buyers are calculating their offers. So it is essential for you to find out buyers first, know your market, find your buyers, and then start looking for those properties specifically to those buyers, and depending on how active they are as well too. But if they're very active, then they're gonna let you know this is exactly what I'm looking for, and that's exactly what you should be looking for them, because that's what their criteria meets. Now, of course, when you have 50, 100, maybe even 1,000 buyers on your list, it's going to be a little bit more challenging to track like how everybody does the numbers. But the best solution to that is basically track who's willing to bring the lowest offer and who's willing to bring the highest offer. That's going to give you like a range of where your numbers should be at, because everybody else is going to be in between those numbers whatsoever. And if it makes sense, they like it, then and the information you send over to them that it's satisfying, then by all means they'll do their due diligence and they'll let you know how much they want to take over the property for, or what's the offer, depending on how much it is that you're asking. We'll touch more bases in that in a few seconds. Next is repairs. So of course, part of the process is getting the property fixed up. This depends if it's going to be a buy and hold strategy, maybe some light touches, or a regular fix and flip deal as well too. So the repair costs can definitely come into play. These repair cost numbers are going to be averaged nationwide, with the exception of some states. Some of those states can include like California, New York, Massachusetts, Florida, Texas, Washington, or even cities as well too. Some cities are very expensive. So when it comes to those expensive cities or states, I would recommend adding $15 to $20 on the price per square foot from these averages, just because again, the expenses are going to be a little bit more hefty on those cities or states. But stick to these average numbers. And then the thing about repairs, I don't spend a lot of time on repairs. I just basically start listing down everything on what it needs. Is it going to need X, Y, and Z, or 1, 2, 3, 4, 5 things that it needs to it? And we'll touch bases as an example right now. But if we look at light repairs are going to be pretty simple things like carpet and paint. And when you think about carpet and paint, you should be automatically thinking about a property that it's in really great shape and it just needs minor touches. Or two, it's a property that is being rented out and it just needs to get retouched up all over again, for the new tenants to be really satisfied and enjoy that unit or apartment or home or whatever it is that is being rented out. So light repairs are very, again, it could be very minimal. Now we're getting to the average repairs. Average repairs is it could be more of the project type of properties where you're gonna start having repairs on major areas like flooring, walls, a kitchen, bathroom, maybe utilities as well too, maybe some landscaping, a roof, windows, doors. Again, that's 9 things automatically, but the main ones are the main areas are going to be like the main project things that are going to be necessary for them to get updated. Again, depending on the property that we're looking into, and then the repairs for these are going to be average between $25 to $40 per square foot, unless you're on those really expensive cities or states, where again I recommend adding $15 to $20 more on the price per square foot. Next is the gut job repairs. These are the nightmare properties or demo properties. And what I mean by that is depending on how bad the property is. If it's like a fire, usually gets demolished from there, and the property has to be started all over again. The only thing that doesn't get demolished is the foundation. But sometimes the foundation has even some major issues as well too. So that's going to be a hefty expense. But this is going to be pretty much an entire full rebuild, or it's going to be like a major update, and it's going to take a little bit more longer, usually 6 to like 9 months, depending on the buyers. Because again, when it comes to repairs, it's a plus or minus game. When it comes to the ARV, it's a plus or minus game, because the property can go for more, it can go for less. The repairs, I can bring a number to my buyers, but they can spend more or they can spend less. It's literally a plus or minus game. So that's why I don't like to spend a lot of time on repairs. The ARV possibly, but again, it also depends on how quickly the investor and their team is able to get the property back again, like on the market, and what kind of process do they have where they're able to get it out there as quickly as possible, so that way they can make their money as quickly as possible. Next, when we're looking for properties, or aka understand like our market, we want to look, or we come across a property that, okay, here's an opportunity. Let's analyze this property. We want to look for similar properties, or aka comp, or start comping the property. And part of that process on comping, you're going to be looking for stick within specific parameters when you're going to be comping some of these properties, because uh, you want to compare apples to apples. Comparing apples to apples is basically looking at your property. If it's a 1960s home, you want to look at a 1960s home. If it's two levels, make sure that you pulling comps for two-level homes. Don't pull comps for one-level homes whatsoever. So you're, again, matching it up to apples. And the first thing that you're going to be looking for is the square footage. On the square footage, it's going to be a plus or minus 300. So if the property happens to be 1,500, you can go up to 1,800 on pulling some comps close to like 1,800 square feet, and then down to 1,200 square feet. Lot size. The lot size, this will vary if you happen to be looking at a property that has like a quarter of an acre, half an acre, 1, 2, 3, 10 acres. Then again, you want to compare more on the lot size, and you want to look for properties similar to the square footage of the lot, which is going to be plus or minus 2,500. Now, looking at properties, you can definitely stick within a radius. You can go beyond the radius, but when you go beyond like a radius of half mile to 1 mile radius, which I recommend, when you start going beyond that radius, then the further the radius it is, then now you have to start making some price adjustments, because you're looking at a whole different neighborhood. When the property gets appraised, the appraiser is going to be looking within that specific neighborhood the property is at. If there's train tracks, if there's an overpass, if there's a major freeway, highway, road, whatever it is, the appraiser is not going to be looking beyond that neighborhood, because now we're crossing over a whole different neighborhood to pull up a comp. Again, sometimes you are able to do so, but again, the further you start getting out, then the price has to get adjusted from there, because it's going to be part of going beyond what it's necessary on the neighborhood. And that's which leads to coming across double yellow line roads, which double yellow line roads are going to be major roads where there's buses, construction trucks, delivery trucks, commuters from home and to and from home. So it's just going to be a constant busy road that, again, one side of the neighborhood, or one side of the road is one neighborhood, and the other side is going to be a whole different neighborhood. And additionally, too, when looking for comparables or comps, you want to look for 3 to 5 comps in the area or in the neighborhood that have sold in the last 6 to 9 months. But not only look for what properties have sold, because properties that have sold is telling you what has happened in that market in the past. You also want to look at properties that are pending or in the contract. The properties that are pending on the contract right now is telling you what kind of properties are major interests right now, and what is the market telling you today at the moment, or basically if it's under contract, like maybe last week, it's telling you like, look, this type of properties are the ones that are selling right now, comparable to like already fixed up homes that are they're staying a little bit longer. And also properties that are available on the market for sale, also look at those as well too, to see what's going to be coming in the future, because properties that haven't sold, it's basically telling us what the future will look like, and see how long those properties will take for them to sell. So we're going to go through a quick breakdown on what makes like a deal work for an investor, because again, investors do the numbers very differently. So I just want to give you guys a understanding on, I will give you a perspective of how an investor looks into like a deal, and depending on what kind of deal they're looking at as well too. But we're just gonna go through like some basic analysis stuff on terms of that. And when we go through the live analysis, I'm gonna be using some free platforms: Redfin, Zillow, Realtor, PropWire, and some of my own tools to help me expedite the process of analyzing some of these deals as well too. Unless you have like a property you want to get analyzed, by all means, drop the address in the chat and we can analyze it together depending on what kind of information you have as well too. But with that being said, let's just go really quick over the breakdown of the investor. See over here. Okay, cool. It's already have it pulled up. Let me just delete all the stuff. Cool, cool, cool. All right, so here we go. Here we have a investor strategy. This is a very common strategy. I'm not sure if you probably heard of it. If you haven't, I'll break over down to it really quick. It's a 70% strategy, and basically, what the 7% strategy is, a lot of investors like to buy properties at 70% of the ARV or after the repair value of a property, which we'll break it down for you right now. So first things first, part of the first process is you have to get like a property under contract. So step number one is get that property or start looking for know your market, have some buyers already to get in touch with, and then start looking for those properties for those buyers already, like I was mentioning earlier. So you come across a property that fits like a buyer's criteria, then they're going to be looking, of course, the seller wants $764,000. I'm just throwing a random number out there because that's what it's like to get sellers that are really interested. Oh, I want to get this much. And you have to understand like what's the situation? Why do they want to sell? What will they do with the money? Are they downsizing, relocating? The list goes on, or whatever it is that they want to do on this property. But you come across a property where there's somebody who's interested in selling, and that's how much they're asking. Two is understanding the repairs. Get an understanding of how much or what the condition of the property is, or if you want to set up an appointment and check out the property so you can get an understanding of what it's like. Or if you're on the phone with the seller, try to get like a virtual tour of the property from the seller directly. So that way you can understand what the layout looks like. You can see like a sky view, or maybe some previous old pictures, but again, you don't know what the new condition of it is. And then sometimes one question I like to ask the sellers is, hey, Mr. or Miss Seller, if you happen to have 60 to like $80,000 like in your account, in your bank account right now, and you were to use that money to fix up the property, what would you do to this property? And have them answer. Like, would you start doing like the roof? You can give out options if you want to. You start doing the roof, maybe flooring, kitchen. Like, what would you do to it if you had that extra money? And they'll start listing it out. Most of the time, I'll say about 95% of the time, they start giving you it. Some of them that are very stern and they just want to deal with like, are you going to buy my house or no? Then it's going to be a whole different conversation from there. But understanding repairs, and based on this project property that we came across, and imagine it, let's say 123 Main Street, this property needs roughly $80,000 worth of repairs. The market that we're looking into, again, not a specific market, which is step number 3, is know what the property can go for once it gets fixed up, which the ARV for this neighborhood or this market that we're looking into, the ARV is $875,000. So the way an investor will start analyzing and try to figure out what their offers should be like, it's going to break down like this. First, we get the ARV, we subtract the repairs from the ARV, which is going to give us this $795,000. From that new $795,000, basically I'll call it the new ARV, we're going to multiply by that 70% strategy, which that 70% strategy concludes of two things. One of it is going to be profit, roughly around 20%, which the investor can make roughly $159,000, or closing costs, and closing costs, sorry, not or, and closing costs, which could be 10% of the buying the property up front as well too, and afterwards, additionally, which is going to be roughly $79,500. So when you multiply that, from that 795, that 70% is going to give you this number right here, $556,500, this is the highest offer, or what's the most that the investor is willing to pay. If they want to do cash, if they want to finance it, however it is that they want to do it, that's going to be their highest offer, because again, that's how the market is happening right now. And the best way to work with the seller directly with this is let him know, hey, Mr. Seller or Miss Seller, based on your property, our offer will be lining up really close to $550,000. And I know it might be very low, but it's completely understandable that you're going to reject it automatically. But the reason why our offer is coming that low is because we're willing to take care of everything else on your side. So basically the $556,000 and $500 is basically what you're going to get deposited to your account. from the title slash escrow company, that's what is going to get directly over to you because we're going to be taking care of all the other fees on our side. First, you also want to make sure that you understand if there's like a mortgage as well too, so that way there's going to be some additional numbers to deal with that. But right now, let's say the property is free and clear, there's no debt on it, uh, um, it's pretty much clean in terms of like the title and everything. So that will be where the offer will stand out. Now, of course, you have to talk with the seller, touch basically a lot of it has to be touching on those pain points. Why do they want to sell? How quickly do they want to sell? What is it that they need the money for to, or what are they gonna do with the money next? Like you just want to basically have a relationship on those pain points and really touch up on that because if the seller is not really motivated, they're not really gonna be working at all with you whatsoever. But let's say miraculously you work your charm, you're working with the seller, you make them understand and how everything's going to be working for them. And maybe you might not be the best fit, but that's where our offer will stand. And again, you work with them, you happen to get the property in the contract close to the asking price of the investor side, which is going to be at this point, it's going to be $550,000. It can happen. It's again, it just takes a lot of work into it and understanding both sides of the story from the seller, your side, and then make sure that you're understanding the pain points of the sellers directly. But you get the property under contract for $550,000. After that, once you get the property in the contract, what you're going to be doing is called a assignment of contract sale. And what that is start pitching your property over to your investors and let them know how much it is that you're asking for. And you might be asking, well, why would I do it for $570,000? When the investor, the most that they're willing to pay for is $556,000. Well, the question is, somebody is always willing to overpay because they play the game in terms of like real estate, either tax game or they just know their numbers very well and they can cut down their costs. So it's going to be one of those two games whatsoever, but always someone's willing to overpay. So that's where you want to do an assignment or contract sale on how much it is exactly that you want to get on your wholesale fee. For example, at this point, it's going to be $20,000 wholesale fee. You have one investor that is the most that they're willing to pay is $556,000, but you're going to have on your list, you're definitely going to have somebody who's willing to overpay, maybe even close to like $600,000 on the property, especially if it's an off-market property as well, too. Like I said, anything can really happen on this deal because real estate, it's a plus or minus game. And especially a lot of investors that have deep pockets, they're willing to overpay for some properties, especially if they're off market. Because again, they have certain strategies that they like to work with, which I know some of those strategies myself. So from there, this is going to be breaking down on the investor's perspective. Now we're going to get an insight of what the investor is thinking on this side. So they're willing to purchase the property for your contract of assignment for $570,000. Part of the process to work with them as well too, or something that you mentioned is like, hey, Mr. Investor, additionally, you'll have to pay the closing costs for our sellers. So it's going to be 5%, roughly 5%. It could be less, and 5% from the seller, 5% from the buyer. So that's what's going to be total 10%. And then the total repairs, when you combine those three together, the investor is going to be the initial investment is going to be $705,000. That could be cash, or it can be some type of finance that they end up getting on their side, or whichever route they prefer to do. Now, from their perspective, let's break it down. If the ARV is at 875, which I mentioned earlier, this is a plus or minus game on any real estate deal whatsoever. It's always a plus or minus game because the property can oversell, or if the property is not hot in July, then it could undersell as well too. It really depends. Additionally, if they work with like an agent to get it flipped up, they're going to be paying those fees and another closing cost as well too. So their actual profit after those expenses is 796, but we have to subtract the initial investment of that 705 that they put into it. So all in all, the actual profit happened to be $91,250, or AKA 11%. Based on the earlier information on the 70% strategy, it was supposed to be 20% of the profit, which was $159,000. But again, at the end of the day, when you do the deep dive on the numbers, it happened to be 91,250. And again, that profit could be plus, it could be minus. It's really depends on how the market reacts on a lot of other factors after the property gets fixed up and it's ready for it to be back on the market. But that's an insight of how some investors think. Not all investors do the analysis and think like that. A lot of them do their numbers very differently. So that's why it is essential for you to find out how a lot of your investors calculate their numbers on a lot of their deals. So hopefully that has able to help you guys understand the bias perspective. So that way, whenever you're looking and analyzing a deal, start thinking beyond on the extra repairs, besides like your wholesale fee, depending on your markets as well too. But from now, we're just gonna move on to doing some live analysis because that's what you guys came here for, to do some live analysis. And if you have some questions along the way, by all means, you can drop your questions on the chat and I'll answer them on my side as I'm processing this. But let me pull this up so we can start looking into some analysis. If you have like a property you want to share, you want a property to get analyzed, by all means, you can drop the address in the chat. If you don't want to, it's perfectly fine. But since there's no addresses, I'm just going to pick a random market over here, which we're going to be doing Naperville, Illinois. So the state of Illinois doesn't allows you to do one wholesale deal for the entire year. After that, you have to get like your license, or I think you can do like one every single year. But what was the city name? Naperville, Naperville. So let's pull up some properties and let's see how we're able to analyze this. So earlier I was mentioning the first process, which is a part of this. I have like a CRM to keep a track of like every single property that we've done on some of these. Right now, it's got cleared up. The last one we did is Rancho Cucamonga. But the way you analyze, or the very first step whenever you're diving into real estate wholesaling, is understanding your markets. And this is the way I like to understand my markets, is first figure out how much our properties are going for. Two is start working with buyers, other wholesalers, title companies, start building my entire list of people that I'll be constantly working with in that specific market. And then afterwards, start looking for properties for those buyers as well too. So it's a few steps, and then once you have your markets and then your people, steps three is properties. Steps four is looking for comps or start finding comps, and then five is getting your deals processed. Steps 3 to 5 is basically going to be repetition every single day, just like any other business whatsoever. But first, understand like your markets. And earlier I was mentioning, how do you analyze a market whatsoever? I've never been to Naperville, Illinois whatsoever. And the way I'm going to be looking for this, the information is really out there. It's available on Zillow. It's also available on Redfin as well too. Realtor doesn't have it for whatever reason, and it's perfectly fine. But all of them, if you scroll down past all the properties, just continue scrolling. You don't have to set any filters or anything like that. You continue scrolling, scrolling, scrolling. Right over here, you're gonna head over to explore nearby and average home values. And what this is basically the research that Zillow, and this gets updated either every month or every quarter, or aka every 3 months. So I recommend you for you to update that. And then you're gonna see how prices are fluctuating. Are prices going up? Are prices going down? Especially when you're tracking that information on your CRM or any platform or whatever source that you're using to keep a track of all that whatsoever. But this is basically telling you how much a property is going for at the moment in those areas. And what I like to do is I like to highlight all of these Naperville homes. It's right there. We can see how much they're going for. And I like to collect all this information, copy it, take it over back to my CRM. Let me go through edit, paste special values, and bam. And what it's going to do is it's going to paste all of that. And the potential ARV is basically on the left side. So here's our property that we're looking into, or our area, Naperville Homes, which they're selling for $555,000. If I were to play the 80% rule, or aka the buy and hold, I need to buy properties at $445,000 or less. This is excluding repairs. I'm not adding repairs right now. I'm just multiplying the asking price, or the ARV, times 70% or times 80%. This is the fix and flip rule, where I got to look for properties that are project type of properties, and then some of them are I got to look for properties less than $389,000. So what I'm going to be doing now is I'm going to be setting those filters. If I'm looking for fix and flip properties, I'm going to be looking for properties worth $389,000. And off the bat, I got 27 results. I'm going to be looking for single family home for houses. There's no houses. Are a lot of these townhomes. It looks like we have some townhomes. And we have one multi-family property. Yeah, one multi-family property. Bam. So those are the type of properties that are going in there. And I have to look, are a lot of these properties going to be type of project properties and whatnot? And what I like to do as well too is I like properties that are over 1,000 square feet and higher. Um, so it's just easiest because anything that's really smaller, it just depends on how the market is reacting. So out of all the results I had earlier, now it came down to 6 results. So this is what I like to use different platforms because some of them give you different information than the others. So I'm gonna do the same thing over here on Zillow, on Redfin. I'm in $389,000. And then let me pull single family home, townhomes, and multifamily. All right. And then let me set the filter of looking at properties over 1,000 square feet and higher. And I got a total of 5 homes. Some of them might be, it looks like some of them are similar to the ones on Zillow, and some of them might not be. And that's perfectly fine. But let's go through Zillow. Let's see what kind of properties we're looking into right now. Most of them, it did look like there were townhomes. Um, and even these townhomes look like they're rentals. So off the bat is I'm thinking that I should be changing the strategy instead of fixing and flipping. It should be more of a buy and hold because this is pretty much in good shape. Maybe just do a little repaint touches whatsoever. So this is where the light repairs come into play. Um, let's see. Is there any project type of property over here? Nope. All of these properties are really, really in great shape whatsoever. So that means the properties over here are not a lot of fixing and flipping. Rather, they're going to be more of a buy and hold. And in the buy and hold, I'm able to raise up the price to $445,000. So let me raise it up, $445,000 because that's what I'm seeing. That's the information that it's giving me, and it looks like I have 10 homes, but all these are brand new, new built homes, whatsoever. So analyzing properties in terms of getting it buy and hold is could be very different than doing like a fix and flip deal. And I'll walk through the numbers on the buy and hold. So let me head over to my calculator for complete rental property. And this is going to breaking it down for me in terms of rental. So the way it works in rental, I'll break it down to you on how it is. First, we have to figure out what the asking price is. Um, Most of the time, it's going to be a long-term loan from it, unless you can do a creative finance deal. We can see what we can work with. But the way it works in terms of rental is you're going to have two things. First is rental income. So how much the property can rent for, or maybe units, if it happens to be like a duplex, triplex, or quad. Um, so this could be rental income. Then it's going to be your expenses. Your expenses are going to be broken down to taxes, insurance, HOA, if there's any maintenance, vacancy management, and anything else that comes into like those expenses as well too. I can break it down dollar by dollar, so that way it's more accurate. Or I can just go based off a specific percentage, which my percentage is 40%, and it gives me what the expenses will be like and then what my net operating income will be. Then the calculator will break down the entire analysis to determine where I should be where the property stands for on certain parameters on analysis, and I will determine what my offer will be like based on cap rate because that's what it will basically will be. What the cap rate, how much we're buying the property based on cap rate. So if we're looking at properties right now that are basically a lot of buy and hold, because a lot of these they're not really a lot of fixing and flipping type of deals. They're more of properties that are already really in great shape, really great condition. They're probably gonna need very minimal touches, or very light stuff, if any at all whatsoever. Just I'm looking at some of these right now, and they're really in great shape whatsoever. So it's just gonna be more of a rental type of strategy whatsoever. And I'll go through that really quick for right now. So let me see. I'm gonna stay away from townhomes for right now. Let's see. Let me look specifically for like houses. Because houses pick more in value, especially over here. I'm noticing that there's a lot of new construction. There's 16 homes over here. There was like 17 townhomes over here. So it looks like the city of Naperville, it's like really well maintained in terms of like value. So single family homes pick up more in value rather than multifamily homes. So then let me look into this one really quick. And this is a really good one. Looks like it got digitally staged. So this is digitally put into it in here. Really great shape. So the way I would analyze it is first thing, get the price. So it looks like they're selling the property for $430,000. So let's break it down right now. $430,000. Awesome. Let's say I want to do 10% down payment on this property. Then I need to put $43,000. The interest rate, I can probably get like 7.5, maybe lower a little bit as well too. I can purchase more points for that. So my mortgage will be $2,700 every single month. Closing costs will probably be more like 30%, 3.5. I'm just gonna leave it at 3.5 right now. So it'll be $15,000. So my initial investment is gonna be $58,000. Now I gotta figure out how much can the property rent for in this area. Let me do two things. One, let me duplicate this, so that way I can go back. Let me look at where my property is at, and it looks like it's right over here. Two, I'm gonna clear all of these filters. That's why I duplicated it. How much is the property? 1,200 square feet. Let me go for rent properties, and let me look for properties that are let's take away homes, blah blah. Awesome. And I gotta look for properties that are at 1,200 square feet. 1,200, 1,250. That's fine. So it looks like I have one property renting it out for 2450. All right, cool. Another thing that I can do, double check, is head over to Zillow rent estimate. Head it right there. Bam. I copy the address. Zillow rent estimate is going to give me a range, but it's going to give me a big bold number on the right side. And it looks like I could rent this property for $2,702. And I have there's this other property renting it out for $2,500, basically. Let me just look at the condition of it. Oh yeah, this is a little less condition than the property that I'm looking into right now. Looks really amazing, especially with that stage. Just staging up the property can definitely bring a lot of value into it. So I can definitely push the property to be really close to like 2,700, because the most I can rent out in this area is $3,000. But based on what I see available right now, it looks like there's nothing really close to 3,000 um, based on the square footage. So now I know I could rent it out for 2,700. So let me go back to my calculator. The property was a 3-bedroom, 2-bath. So let's head over to the 3-bedroom, 2-bath section. So it's 1 bedroom, 3 bedroom, 2-bath. I can rent it out for $2,700. Um, is there a garage? There's a garage attached to it, so that I can either block off the garage or I can allow them to use it. Trust me, I'm here in California, and I know some people that rent a full house and they don't have access to a garage. It's crazy the things that you can do. I don't know what the regulations are in terms of like Illinois for like the garage rental or anything like that. So that's something else I'll probably have to look into, see what I can do with that, if I can charge them extra on that. If I were to charge them extra, it will be the garage will be one garage. $50 extra a month. So again, is bringing me extra income. I can't do laundry and I can't do anything else because it's a single family property into it. So that's the only thing. Those are the only two things that I can do: the rental income and the garage. I can charge them for the garage. So total every single month is bringing me $2,750 per month of income, or a total of $32,450 for the entire year. Now, like I said, I can break down my expenses to the dollar on property management, usually at 10%, 8 to like 10%, taxes, insurance, all that. But I just want to play it safe and just go with my straight number, 40%, which is my 40% is going to be $12,980, which is cool. All right, cool. I'll stick with that number for right now. When I subtract my income, the $32,000, 450 minus my expenses is going to give me a net number. And that net number is $19,450. Or if you divide that number into 12 months, it's going to be a total of $1,600 of income each single month. Now, the only thing about this though is one of the expenses, if you hopefully you guys did notice, is there's no some of these expenses is not the mortgage. The mortgage is called the debt service. So the debt service gets subtracted from the net income. So what was my mortgage payment? $2,700 each single month. and my net income is 19,470. So when you multiply the 2,700 times 12 months, it's going to be a total debt service of $32,471. When I subtract that number from my $19,470 of net income, I'm losing money on this property automatically. This property, it's not even cash flowing me anything whatsoever. I'm negative $13,000 each single year, or aka $1,000 each single month. So based on the price of the property is at right now, which is at $430,000, this is not bringing me any income whatsoever. And I'm gonna ask you guys can put it in the chat as well too. If the property is not bringing me any income whatsoever, what are two things? What's the first thing that you would do, and what's the second thing that you would do to make this a little bit more reasonable to make you some money off the bat? Because right now it's not bringing me any cash flow. You guys can put your answers, or if you don't want to answer, it's perfectly fine. But what would the two things that you guys would do to make this property bring you some income each single month? What will be the first thing and what will be the second thing? You guys can put it in the chat. Let me see. Uh, raise the price, Mr. Anderson. Raise the price on what? You have a really strong starting statement. It's just raise the price on what? That's the only thing. Like raise the price of the property or raise the price of the lower the acquisition size. Okay, cool. Negotiate for a better rate or come in with a bigger down payments. Okay, awesome. So really great answers. So first thing that I will do is negotiate on the price automatically. So lower the acquisition price, Arthur. That is correct. Definitely lower the acquisition price. And the question is, where should your offer come down to? Because we already know we're already limiting the we're already understanding where the rent is at, but now the pricing, where would it really make more sense for it? So right now is based on the numbers on the rental and how much the property it is, it's telling me that the cap rate of the property, and what cap rate analyzes is basically the net income that it brings over the price. And not only analyzes that as well too, but also it analyzes the risk of the investment. And the lower the cap rate it is, it's going to be a higher price on the property, which is going to be a riskier investment. Because if it's a risk investment, then you're playing the long-term game. But from there, you're going to be additionally have to consider what kind of income and is it bringing over to you. So I don't know, Naperville, Illinois, what the average cap rate on properties are, but I can find out in a matter of seconds by simply typing Naperville, Illinois average cap rates. And so I want to understand, like, based on the numbers that I have so far, which it's a 4.53% cap rate on this property, and even at that number is not bringing me any money whatsoever, then I would need to figure out, like, is that very normal for Naperville, or is it going to be too low where the sellers like really asking for this property whatsoever? And it looks like I have some rates over here, but this is multifamily. I want to look for single family homes. Chicago, Naperville, Ain. I'm looking for one of these government websites. Where is uh let me look at this one. Apartments loan store. I'm looking for single family homes. So class A, yeah. So it looks like, but that's multifamily. Talk about single family. So let me type in that single family home. Awesome. Investor Naperville. So it looks like the average single family homes cap rate is at 4.65%. Looks like that's from Mashvisor. Sometimes it's very accurate, sometimes it's not with that whatsoever. NAR, I don't trust the NARs after, especially with the case happening right now. But let me go with Match Visor for right now. On the single family homes, um, going at 4% cap rate. Where's the information? Doesn't want to give it to me, but that's what I'm seeing. It's a 4.65. So it looks like the property is priced right there perfectly fine on the spot, and it's the cap rate's a little bit lower than that 4.65. So if 4.65 is the lowest, then again it comes with negotiating. Because if I reach out to the agent, that's the first thing I'm gonna ask him, like, hey, is the price negotiable? And off the bat, they tell me, yeah, the price is negotiable. Cool. Then I know I can definitely do something with it. If the price is not negotiable, then it's something that I have to move on forward to move on to like something else. It's as simple as that. Simply asking that information. Once I know that the price is negotiable, awesome, and understand like why the seller wants to sell, then that's where I want to work down over here to my cap rate. So right now I'm a 4.5% basically. I start my negotiations very high. So I want to push it up because I want to work backwards where I want to come down to my specific number. If I throw my specific number off the bat, then it's not really going to be working from there. So honestly, I will push this really close to 6.5, maybe like 7%. Just so I can understand where the offer will be. Maybe if I want to do a cash offer as well too. It just really depends on this. But roughly around even at $300,000, that's like a 30% discount from the current asking price. But I need to figure out where it will make sense where even if I'm losing a little bit of money, it's more about the long-term strategy. The long-term strategy is going to be the tax deductions of it, which basically is just going to be tax reductions. I just playing the depreciation game, and over time the property is going to pick up in value. And after that, maybe I can work with the tenants on making like a long-term tenants, depending on that or what kind of leases I'm able to get. But it's going to be a very long-term type of strategy. I'm estimating 12, 15 years type of strategy where I can resell the property at a lower cap rate. So basically sell it close to like where it is right now, 4.5, maybe 4.6%. But again, I need to work a little bit higher than this and then work my way down. The most I will push it into will be close to like 5.25 or 5.5%, which is $350,000. But again, I'm gonna be playing a little bit more aggressive. So I will start closer. What is it, 6.5%, 7%? So 280, 300. So I'll start my offer close to like 285. 285. I need to figure out can this property bring me money at 285? I'm not saying I will, it will. I am gonna get at 285. I'm just trying to figure out like where will the number start out. And somebody else did mention as well too, if we can't work like in the property, then put a bigger down payment down. And that's true. I can definitely put a bigger payment down. But again, there's different strategies when it comes to like 10%, because sometimes pushing it to like 10%, I don't really have like a lot of benefits. And when it comes to like tax season as well too. So 10%, I noticed it's been very common to use that 10% down for some tax purposes from it. So the strategy at 285, the monthly of the mortgage is the only thing that I'm looking for. I'm not changing the rent. I'm just trying to change two things, the price and then the mortgage payment. And I figure out if I'm figuring those two out, I need to figure out where it will bring me some money. At 285, even at 285, I'm losing $2,000 each single year on this property. So as you guys can tell, it's gonna be very challenging even to like get it to like $300,000. I'm gonna be losing more money. So um, the very first thing is the pricing. It looks like the pricing is not gonna be an adjustment, so it's gonna be more on, like somebody else did mention, it's gonna be more like on the down payment. I'll probably have to push my down payment a little bit more. But even if I push my down payment a little bit more, I am still losing a little bit on my down payment at this one, but it's at 300. Right now, I'm putting a property at $300,000 of the asking price as an offer. I'm putting a bigger down payment as well too. And at this point, if I'm putting like a bigger down payment, which is a down payment of $60,000 and doing like the closing costs as well too, at this point, I'd rather do a creative deal with the seller directly. Convert the homeowner again, depending on how much money it is that they need at the end of the day. But I will work on with the seller directly and also with the agent on doing a creative deal to convert the homeowner into the bank rather than me taking out a huge interest um on this property whatsoever and putting a big down payment on this property whatsoever because I can play the refinance game later on. Maybe in doing instead of doing the property as a regular rental property, maybe do the property as a rental a Section 8 rental property. And I will have to look over the Section 8 rental analysis, which is Naperville, Illinois, Section 8 um, housing. Uh, what is it? Housing authority. Authority. I can't spell right now. Awesome. Let's see. So, Naperville looks like it's in uh Dupag or Kendall Housing Authority. I gotta figure out what housing is it on. But dupeghousing.org. I need to figure out what the numbers are for Section 8. Home ownership program, home veteran affairs. Hold on, where's my that's not it. Where's the rates? Where's the rates? Section 8 housing, affordable housing. I'm just trying to pull out Section 8 because that would be where the creative deal will come into play of doing a Section 8 deal, housing authority. Not the vouchers. Why is it pulling up the county? But that'll be the only thing because Section 8 will definitely bring me more money into the property. Of course, it's dealing with the tenants as well too, but I'm out of state, so I'll have the property management make sure they find that out for me. There's nothing's pulling up on that on the city for it, but that's the way we'll do it because what Section 8 will do is the government will pay 10, 15, 20% more than what the property can rent for. So it could bring me more money. So that way I can make a creative deal to the homeowner directly and then bring that type of offer to them. I know this is a little bit confusing on some of the things that I'm touching up on. But that's the thing is having backup strategies. It's really essential and understanding like all the different type of strategies that you have to constantly be analyzing on a single deal because the sky's the limit on what it is that you can do. But there's a few more things that I'm able to do so that way, because the property so far it's gonna be a little bit too expensive. It's not gonna be bringing me some money down whatsoever. Like I said, I can play the long-term game even if I'm losing $667,000 which this was around $300,000. It was like around 25% of a discount from what a homeowner is asking for, which is going to be $130,000 of a difference. And that's the thing. The property hasn't it's only been on the market for 12 days. But it is in really great shape. I don't really have to do anything too much to it. And then the area just overall, it's like really expanding as well too, because there's new townhomes getting built whatsoever. And then a lot of the rentals are just going out of it. Oh, Arthur, you're able to find it. What is it that you found? How much does it say on it for you to find out? Because, but here, let me head over to HUD user, and here's what I'm gonna be able to find it. Especially what was DuPage County, DuPage, housing market conditions. Regional housing market data analysis, region 5, fourth quarter. That's not it. Hopefully, if I'm not able to find it, I apologize. I'm just like stalling at this point. Um, because I'm trying to look for here we are. I found it. I found it. Illinois school, D. DePaul, Illinois. Next screen. All right. What's the zip code for our property? 60565. 60565. 60565. 605. Here we go. And then our subject property is I think it was like 12. Is that a three bedroom, two bath? Because that's what it goes. Three bedroom. All right. So the fourth panel. Fourth panel, 605. So it looks like, oh, geez, 2740? They're not even willing to overpay. Wow, that's crazy. 605, 65? 605. Yep. That's it right there. So I'm capped. So this is not gonna be a deal that I can work with, even with doing a creative finance deal whatsoever. So this is just something that I have to move on past. It really sucks, but it's just part of the game. It's not gonna be working on the creative finance. It's not gonna be working um on the Section 8 housing or strategy whatsoever. It's not going to be working on the fix and flip unless I do like a minor flip, but it doesn't really need anything whatsoever. So honestly, it's just again, it's a deal that I have to move on past it, and it's as simple as that. It took some research, but that's what it is. Looks like Arthur, you have well, this is from a HUD user directly as well too, based on that zip code. So if you have like the zip code there whatsoever, um, then yeah, if the number is bigger than that, but you're looking at the 2023. This is going to be the 2024 fair market rents. So I'm not sure if the one that you're looking because I see 2023 right there, maximum. So this is going to be 2024 fair market rents. So this is the thing that we have to bring into it, and it's a three bedroom property that we're looking into as well too. So we're capped on it whatsoever. And so the looks like just what we learned from Naperville, Illinois is a lot of the properties are good rentals. It's just great condition properties, and they could be good rentals. It's just the numbers really has to make sense on it. Something that I want to do um is look at how much a property is going for on this area based on the 1200 square foot. Maybe I can do like a small like a really like a small um fix and flip deal on this, but there's just let me see what's pending on the contract. And it looks like the $300,000 price point, it's not bad whatsoever. We have a 1300 square foot over here on their contract. Um, okay, really good mint condition, 370, and that's how much they're asking, 370. This one is going for 380, 1100 square foot home, three bedroom, two bath, and I'm pretty sure that that price is definitely still negotiable as well too, maybe like by a few thousand. So and this is really close to our subject property. So if this one is going for 380 and this one is selling for 430 and they're in the same neighborhood. They're not crossing major roads, nothing whatsoever. This property it's really overpriced. And my only guess, just by seeing these two numbers locally, the 370 and the 380, and this is at 430, this is telling me that it's not a seller, it's more like the agent, that this agent is like overpricing this property. So if I were to wait 30 days, 30 to 45 days, and this property is still available, it's because the property is overpriced. And if within those 30 days, there's no price reductions whatsoever, then it's a combination of both the agent and the seller as well too, where the seller is just stuck on that price and they're not willing to negotiate or whatsoever. But just those two numbers themselves give me like a huge information on how the property is really overpriced whatsoever. Um, but now let me look into this real quick. Let me look at how much properties have sold in the last 6 months. And looks like we have a 430. And then this is probably why the agent is listing it at 430 is because of this property that sold on April 5th. They're like, oh yeah, we can sell it for 428. It's in really great. This other property was in really great shape, so we can for sure sell it at 438. And it doesn't look like they our subject property looks in better condition than this one as well too. But this sold for 430. So that's where that number came in, like especially with the property being listed for really close to the date. There's this other one, 390. So if I were the agent, honestly, I would average it out and then go with like $400,000. So that way the property can sell really quickly. This one is at 350, sold in December. This is in a little bit less shape from there whatsoever, but and looks like it needs some work as well too. And that's all for 350. So honestly, I'll say 410 and then sell it at 400. That's perfectly fine whatsoever to get the property sold as quickly as possible. But selling at 430, I see why the agent pulled at 430 just because of this property that recently sold um as well too. And it's been listed for like 12 days. So really it's like right on point. Um where this property was listed and it took like a while for it to get sold. How much did they start up with? They had to start up a little bit high, probably. It was listed at 419. You see, even this property at 419, it went over asking. That would be my strategy if I was an agent. Is listed at 410, and if it sells over asking, cool. Rather than it did take some time, took about 2 months. So I'm guessing that our subject property is going to take about 2 months for it to sell. So 60 days. So that's where my thing will come into play. And the agent is doing a little bit of reverse where they list it high and then they start working on the price from there. But it's pretty understandable. Numbers really don't lie or whatsoever. So whenever you're analyzing, it's really down to like the numbers on any single deal. It's going to be either in the fix and flip, it's going to be like a buy and hold. If you're trying to do a brand new construction home, it's really down to like the numbers, and numbers are really not going to lie to you. Numbers are going to tell you what kind of strategy is being done on this, or what the potential profits were done on this. So numbers are really not going to be lying to you because there's no way to adjust in, especially when it comes to a real estate. The only way it can be a little bit tricky is coming across states where they don't disclose what the property sold for, or aka non-disclosure states. I think there's about 12 to like 15 non-disclosure states out there. Those make it a little bit more challenging because you have to dig really, really deep for you to find out how much the property really sold for whatsoever. But hopefully that's able to give you guys like an insight on how to do some analysis. I know it wasn't like a very thorough one on terms of like fixing and flipping, but it was more understanding that it's really comes down to like the numbers whatsoever. Of course, it just takes repetition. I don't expect it for you guys to learn it from the beginning. It just takes constant repetition. For me, it's really easy because it's been constant repetition, working with investors, doing some wholesale deals, doing a lot of analysis, working with agents, working with other wholesalers. So it's just constant work from there. But I'm gonna leave it open for some Q&A. If you guys want to share any takeaways, any insights, anything from there as well too, you guys are able to unmute yourselves. But this will be the time for some questions. If you guys happen to have like any specific questions regarding market analysis, properties, and processes whatsoever. So I'll leave it open for you guys if you happen to have like any questions whatsoever. You guys can drop your questions in the chat or you're able to unmute yourselves if you guys
Hi,
want.
Elton. Good morning. This is David.
Oh, hi,
Calling
David.
from
Good
Los
morning.
Angeles. Good morning. You mentioned, some creative strategies. Can you give the titles or the names of those strategies? I know that you mentioned, you can make the buyer kind of like the bank.
Mm-hmm.
And so I found that very interesting. So is it possible for you to kind of go over that again, or at least just kind of give the names of those strategies, because I'm fairly new
Mm-hmm.
to this information, and so all that is very interesting.
Yeah, so when it comes to doing a creative deal, that's what it is. It's just creative finance. So
Okay.
you're working the deal directly, especially if there's an agent involved. On our example that we're looking for today, there's an agent involved.
Mm-hmm.
Is who's going to be paying the agent because the agent needs to get their commissions. One. Most of it comes down to like the buyer, aka if you happen to be the buyer, David, then you'll be paying the commissions to the agent, whatsoever. Because again, we're not selling the property. It's not a purchase and sale agreement type of property. It's just working with the homeowner directly on what the terms will be. So you bring a set of offer or terms. Those kind of terms will look like the following. Just think about it as if you go to the bank. The bank is going to ask you, well, how much is the property? How much you're gonna put down? What kind of interest? And then they're going to be telling you what kind of interest you're going to be receiving from their side based on a lot of fact income, all this and that. But the cool thing with the creative side is you don't have to go with the bank. What you're doing is you're letting the seller know and the agent know, hey, instead of me going to the bank, getting a crazy high rate whatsoever, like, are you looking for this just to get money out of it so that way you can use it for like buying like another property, or is this an investment property that you have like on the side that you're just trying to get rid of out of your portfolio and maybe to use it as something else? Like, and the reason I asked that is because um, I'm curious to seeing if you might be open of doing like a creative a seller finance deal. That would be like the strategy to answer your first question of what the strategy will be, a seller finance. And what the seller finance is, Mr. Seller, I convert you, the homeowner, into the bank where I deposit. I don't know how much it is that you need down. Do you need like 30,000, $40,000 down up front? I'll bring you the 30, $40,000 money up front. And instead of me going with the bank and getting a crazy high rate, we can work on the rates directly from you, which is going to be way lower than the current market rates that are available out there right now. It could be 4%, 5%, whatever it is, but it's going to be way lower than what it's available on any loan at the moment. And what you're gonna do with that is every single month you're gonna be paying the seller directly their monthly um, the set payments that you're gonna be making every single month. But the strategy on your end side, it has to be where as I was explaining, is part of the first process of buying like a rental property is make sure that it brings you some income. So if you're doing a seller finance, the way it will be is you gotta set the conditions on the down payment, how much you want to pay every single month to the seller, how long, which is called a balloon, and or a wrap, not a wrap. I'll say balloon. Balloon is the right word for it. Where how long is it gonna take you for you to pay off the entire property to me back? Sometimes they'll be like um, they want to do really like short times, like 5 years, 7 years. But depending on how much you're putting down, then you're able to, if you're able to put down more, then now you're able to extend the time frame that you have to pay the entire property or whatever's left over on the property back to the homeowner. So the homeowner wants $430,000 for this property. All right. So you put $30,000 as a down payment instead of getting like a um 1,600 what was it, sorry,
Appreciate it.
$2,000 payment on a traditional loan. You can work with the seller directly and be like, hey, can we come on an agreement to doing maybe like 1,500, 1,600 every single month. So that's going to be your regular monthly payment, and I'll pay the rest of the balance because each single month you're making payments. Whatever the balance is left over after you making the payments, let's say in 10 years, whatever that balance of a difference is you have to pay that money up front to the homeowner directly whatsoever. So in 10 years, is the property going to pick up in value? Yes. Is the value going to be more than what that remaining balance will be? Is definitely not. Because what you're going to be doing in 10 years is you're going to be refinancing it. But the way the strategy works is that the property you're renting it out to, again, Section 8, which we noticed Section 8 was renting the most that we were able to get was 27, unless proven otherwise. It was a little bit different, but based on the 2024 markets, it looks like the most that you can get for the property is $2,700 whatsoever. So if you're renting out the property for 27 and you work with the seller directly on getting on renting it out or paying the mortgage, aka mortgage payments, but you're paying that directly to the homeowner, is you guys came into agreement at like 1,500, then you have $1,200 of income each single year. Now, the only thing that you have to take care of on your side is having a property manage it for you, whatsoever. If you happen to be like out of state, or if you happen to be in state or in the area, then you can manage the property yourself. So that way you can bring your expenses. Where the strategy is basically for you to make some money out of that difference from what you're paying to the homeowner and how much you're renting it out. But the biggest strategy of it all is basically that in 10 years, depending on the balloon that you're putting on the contract, if the seller happens to agree on 10 years as well too, maybe 7 years, 8 years, but usually 8 to 10 years is like the standard on doing like a creative finance deal, is the perfect time frame. Where in 10 years, is the property going to be worth more than $430,000? Most definitely it will. And what you do is you refinance in 10 years, you take out you get the money tax free, you pay whatever the balance is left to the seller directly, you pay them off. If you happen to have any cash left, that's for you to keep to yourself, so that way you can look for other investments, or because you refinance and the cash that you have left over after paying the seller, if you happen to have like anything left whatsoever, you can spend it on to like yourself, because again it's tax free, or again, you can go buy some other investments whatsoever. So that's like, I know it's a little bit confusing, but the main of it is working with the seller directly on getting the property, of making them the bank, because just because the rates are just way too high right now. Because what's going to be working on your best interest is, even in the next 2 years, just in the next 2 years alone, if the rates just drop, the property's value is going to pick up significantly, especially single family homes. Single family homes in good areas, which based on what I was looking, it looks like it was like a class B, maybe a class A area, where it can definitely pick up a significant amount of value. In 10 years, even just in 2 years, I'll probably say it'll probably be worth $525,000. And again, if you refinance around then, the sooner you pay off the seller, then the better it is. But again, it's always best to wait longer, so that way you're able to get more out of it. But that's the seller finance or creative finance deal,
Right.
whatsoever, to break it down for you. But
Okay.
additionally, too, you have to pay the seller like the down payment, but additionally, you have to pay the commissions of the agents, which most of the time, all the time, it's disclosed um, on all the platforms out there, Redfin, Zillow. If it says like
Yeah.
buyer's agent is like 2.5%, then that means the seller's agent is making 2.5%. So you have to make 2.5% on how much the property is selling for,
Understood.
whatsoever.
But thank you for that breakdown, Elton. You really cleared it up for me. I've heard about this concept a lot, but I never understood, that one, the balloon, and then two, that you would give the seller the down payment,
Yeah.
just like you would a bank, right? When you're
So
borrowing.
you still have to go through title for everything for that,
Hmm.
because
That was my next
the
question.
property is being sold, and it just
Yeah.
everything for them, and they're the ones taking care of everything. And again, the agreements are there on all the parties, so that way, if for whatever reason the homeowner or the seller happens to do something shady, then the contracts are laid out, everything went through title. It's just more on working on like on the suits. It rarely happens. It's just like it depends on like on the seller's motivation, but
Yeah.
most of it comes down to like how much money they need up front. You always want to aim to get like really close to like 10%. That's why in the
Hmm.
beginning I was talking about like just putting down like 10% and what that 10% will look like, just because you want to pay as much as low as possible, so that way you're able to again make more or use your money for other investments whatsoever. Because putting
Yeah.
20% down, that was like $60,000. And again,
Yeah.
if you're able to do that with one property and then save the other half for another creative finance deal and another property, or even do it for your own, to have like your own take over like the property or somebody else without going the traditional route, it really it's significant, which a lot of people do. But the
Yeah.
main strategy of it all is literally the rates. You're playing the rates game. you're playing the tax game, and you're playing the waiting game. And those three are very deadly in real estate because that's especially how it is currently right now at the current markets
Yeah.
um, whatsoever.
Okay. Thank you so much for that. And
Of
then,
course.
so then, when you write up this offer, you said the title and escrow company are the ones that write up the offers, or they just approve things, process things,
They're just
and
working
you
the
write it.
processes of the down payments, the balloons, and everything
Mm, I
is going to
see.
be from there whatsoever. Because again, the title are the property is still being sold, one, and
Hmm.
everything is going to be recorded
Yeah,
onto the title to make sure that the seller is actually the
I see.
homeowner of the property, make sure everything is clear. There's no
Okay.
debts on the property. If there's a mortgage, this works even better as well too. If there's a mortgage, because now you're doing to a different strategy called subject to, where you're taking that subject to the mortgage whatsoever, but that's even a more thorough explanation on that. But yeah, the title is going to be taking care of all the funds whatsoever, because again, you never want to deposit any money directly to like a homeowner's account
Yeah.
whatsoever. It's literally down to like the title, so that way
Okay.
everything gets recorded from there.
Got it. And then, yeah, so your agent or whoever the agents kind of work out the deal, right? Or write up the deal. I'm
Yeah,
assuming.
the agent will write up the deal. Here's the thing: if you happen to come across like a you want to do like a seller finance, there's a deal involved. It's a two-party explanation, and what I mean by that is some agents are not really don't like to do it, don't like to do that. They're like, oh, I don't want to bring that offer to like my agent or to my seller, whatever. So occasionally you will deal with those headache agents that just are not willing to, and it's perfectly fine. But you have to make them understand, and you have to explain it to them how it works. And then additionally, too, they have to explain it over to the seller. And sometimes it can get misconstructed and
Yeah.
misconstrued, where the seller is just gonna accept like your offer whatsoever.
Yeah.
But the cool thing is, if the property is still available after you brought in the offer and it got rejected from the seller, because again, it's all comes down to explanation whatsoever. Sometimes it's really good to get in touch with the seller directly, which you can pay services to get as called skip tracing, and reach out to the homeowner directly from there, so that way you can explain to them like, hey, I'm not sure if your agent brought you this offer. I submitted it. I see the property still available, but I'm willing to make convert you into like the bank. And you start explaining everything to them. And if they really like it and they're like, well, yeah, I would rather do that than, because my property is not selling, it's been sitting for a while, especially like 60 days. You can come across properties that are selling for like 60 days, and you can do a seller finance deal. You can pitch it over to them. They'll be head over heels over that, and it's just gonna make it even flawless, and it's gonna make the agent kind of look a little bit bad. But again, it really comes down to like how you're working with the agent
Yeah.
or whatsoever.
Yeah. Sometimes having less people involved is better, right?
Yeah, it is. The only ones, as long as you're, like I said, as long as the title and escrow are involved, everything else will go flawless. It just make sure everything is being very well explained, and make
Yeah.
sure the numbers also make a really good sense as well too.
Yeah. Okay. Thank you, Elton. Very helpful, man. Thank you.
My pleasure. Anybody else with any other questions by any chance? Anything that pops up in your mind through that conversation, or anything else that just pops out from the earlier topics or analysis? All right. Well, if there's no other questions whatsoever, I really appreciate you guys coming in for today's event. The next one will be on Sunday at 10 a.m. Pacific Standard Time. If you guys happen to have like a property and address, do you want to get it analyzed, or any questions whatsoever in the future, by all means, come back again. The recordings do get these live Zooms do get recorded, and they're available on my website. I dropped the link on the chat whatsoever to my website, where you guys can watch it. If you happen to really touch up anything from there, or you want to touch bases, or look at any previous all, I think it's 39 previous live Zooms of anybody else asking all different questions whatsoever. Um, what's the average wholesale fee you charge? It really depends on the markets, Arthur. I'm mainly on Midwest. I'm in California, so a lot of my deals are in the Midwest states. Arkansas, Alabama, Indiana, where's it? No, not North Carolina, New Orleans county as well too. So it just depends like where I'm at, but roughly on those states, wholesale fees are between eight to like $12,000 on them. When I used to do them a lot more, I'm mainly focusing on acquiring properties, rental properties at the moment on some of those states as well, just because they work in favor of the landlord, aka me, or wherever the property is listed under as the buyer. But those landlord friendly states really work best because if tenants happen to be missing payments or squatters is becoming like a major issue all over the US as well too. There's more strict laws on my side, or where I'm able to do whatever I want with my property regardless of whoever it is, unless I'm breaking terms on the lease. Then that's going to be a whole different conversation. But if I'm not breaking lease and the tenant is breaking some terms or there's some issues with that, then I'm able to do whatever I want with my property. So look into a lot of red states if you're looking for buying and holding, just because a lot of renter friendly states are really good in terms of value, but they're not really good in terms of like when it comes to tenant issues, because tenant issues are rising up really bad as well too, especially with prices and everything rising up. Or rent, it's gonna be a lot of properties that need to be rented out, but it's just part of the stress game of being an investor whatsoever. But to answer your question, that's how much wholesale fees are in those markets, depending on where you are. California is more expensive, so you probably get higher wholesale fees. California, Miami, Texas, New York, Massachusetts, Washington State, in Seattle, those markets are very, very expensive. So you can definitely get higher wholesale fees. And also depends on how much you get the property in the contract as well too. So the better you are negotiating, the better you are also bringing an offer in, working on those pain points. You're kind of like pitching a lot of that whatsoever. It's really going to work in your favor to get a higher wholesale fee too. So it really depends on your work and depends on your markets as well too, to help you answer your question. Anybody else? Any other questions? If not, then that's gonna be pretty much our wrap for today, guys. Thank you again. I really appreciate it. Again, the next event, our 41st episode is gonna be on Sunday at 10 a.m. Pacific Standard Time. And if you're not able to make it, again, it gets recorded every single time, so that I'll be able to rewatch it. And the link is on the chat, which you can head over to eltonvargas.com later on if you want to watch that, or if you really want to watch really want to watch some of the previous ones as well too. And my pleasure, guys. Thank you. You have a blessed rest of the day. Take care.